and welcome to Investors Hangout. In the past few weeks, we've been seeing bull run in the market. But the question that comes immediately is, will 2008 be repeated? Will we see a correction in the market? If that were to happen, are mutual funds equipped to handle it? What should the investors be doing? Whole lot of questions which the CEO of Value Research, Dhirendra Kumar, will address today. My name is Rajesh Lake, and this Investors Hangout is brought to you by Aditya Birla, Sun Life Mutual Funds and Value Research. So Dhiren, I'm going to make it easy for you to answer because 2008 everyone has experienced. So is it inevitable? Is it going to come? Or we should just relax and wait for things to unfold?
The honest answer is that nobody knows.
Nobody knows.
I don't know. So does anybody. But I still feel that the magnitude of 2008 was very severe. I think that was once in a 50-70 year kind of event, and it was the magnitude was very significant in it because it was a lot of coincidence, bad coincidence happening at the same time. The global financial crisis, then the collapse of Lehman Brothers, the kind of exuberance we had seen before, and the whole the global connection, the whole globalized economy. So it had a ripple effect. I don't see the sheer coincidence of so many bad news happening at the same time. But at the same time, nothing can be ruled out in the market. The lesson from 2008 is something which we should really take it to heart, that don't act in a huff, don't panic. Because in times of panic, anybody who actually in the post 2008 situation, in the whole collapse, anybody who bailed himself out of the market in his nervousness or the steep decline, not be able to withstand the big decline in a brief period, they booked their losses, and they booked their losses permanently, and they booked their losses. I think it had a far greater psychological impact that all those people who got out could never get in again.
Right. So it's okay to have the fear of heights?
It is okay, but you need to do something about it, and there are a few simple things which everybody needs to do. One is that a bull run of or a rising market of the kind that we have seen, it creates overconfidence. It makes you think that you can take all the risk, you can withstand any decline. People are sitting on profit. You feel happy on a day-to-day basis. Market goes up by 100 points or 200 points, and you see your money going up. Your whole accumulation goes up. So you feel very happy about it, and you forget that it comes with a risk. It is markets are cyclical. Markets can't be at 25% or 40%, or what happened to small cap funds last year, went up by 50%. And many investors will believe that it is 50% yielding instrument. Not so. It comes with its problem, it comes with its volatility, it comes with its intermittent decline, and it will actually be stomach churning big falls in the interim. And that is something which many investors may not have experienced in the last 2-3 years. But at the same time, the good news is that we see large number of regular investors, which mitigates that risk. The possibility of reducing the possibility of catching a market high. Then comes the kind of funds which are being sold or which have turned very big of late. They are generally not the narrow ones. In pre-2008, people were buying infrastructure fund. People were buying very specific kind of fund, or people were investing lump sum in large quantity, in large number. And not so this time. So what I find different is that there are more large number of regular investors. There are more investors who are investing in balanced fund. There are more investors who are investing in equity income funds. They are the ones, they are low risk. They don't fall freely when markets fall. So that I think is, is the shock absorber, or I would say the insurance against a big decline, which will not be as unnerving as 2008.
So we should keep in mind about mutual funds are subject to market risks.
Oh, of course,
the time.
Every mutual fund will fall, except for fixed income fund. If the markets fall, every mutual fund will fall. But you have to understand that which will fall more, which will fall very freely. The small cap funds which actually went up by 50%, they have the potential to go down in value by 50% as well in a brief period of time. Maybe they returned 50% last year, and it can go down by 30-40% in a matter of few months. That is something which many investors may not be aware of, may not have experienced it. Even if they are being told, they will not take it to their heart. At the same time, the balance fund and other things, the equity income funds, lower allocation funds to equity, they will provide you a relatively steady experience. So that is something which investors need to appreciate, that what they are invested in, what it will translate into, and are they in the appropriate one, and maybe change course. If you accidentally hit upon a mutual fund, maybe change course.
Okay. If we were to divide our investors into two, say those who are mature investors and those who are relatively new investors. So let's take up the mature investors. If 2008 scenario market correction were to take place, then how should they handle it?
A mature investor, relatively older investor, if you are onto a plan, if you are onto an investment plan with the appropriate kind of fund, if you are a first time investor investing in balanced fund, doing your SIP, do nothing. Do nothing and make sure and feel happy with a market correction, because you will be able to, because if you have 2-3 variables in place, one is that you are investing regularly, the other is that you are unlikely to need the money for next 5 years, which means you are a long-term investor, and so you should feel happy that you will be able to buy cheap. Otherwise, you're buying expensive when the markets were at a higher level, and make sure that you're not watching the market on a moment-to-moment basis. That is why you're a mutual fund investor, and that is how you'll be able to benefit. Because if you watch it very closely, if you look at the values every day, maybe you will panic. You will find it very unnerving. But we are talking with the assumption that as if the market is about to fall. One is that we don't know, and it
in
may
a likely
not.
scenario, we just,
there is a great likelihood that markets may not fall because a lot of changing complexion of the market, economy, and it's extremely important to stick to your investment plan, not redeem your investment, because if you you make your losses permanent the moment you take out, and this is taking these 2-3 things, I think it will make sure that all those investors who were able to stick through that 2008 period were able to treble or quadruple their money in next 2-3 years. Otherwise, they would have been sitting on losses and permanent losses, and will never have the courage to get back in again. So this is important. Sticking, your ability to stick to your plan, deal with this adversity, and these are adversities in market, of very scary ones. These are inevitable. They will come. If not tomorrow, if not few months, maybe 3 years from now, you will come across these situations, and your ability to withstand through that adverse period is critical to your financial success.
Okay. So this is about the mutual.
This is about the mature investor.
Mature. What about the relatively newer ones who are just entering? What should they be doing?
They need to really revisit that. Are they onto a plan? Because many of the new investors, relatively newer investors, last 2-3 years, they would have accidentally landed into a mutual, started investing in mutual fund. Many of them would have invested one time, lump sum, and they will be feeling very happy about it. That market has gone up, so has their money, and it is time that you plan. Because if you're a first-time investor and if you're in the small cap fund, the excitement that has been caused by the rise in investment values, it will scare the hell out of most of these investors, and because the free fall is something which has to be experienced. No amount of preaching or talking will actually help you appreciate what that free fall means. If you have accumulated 30 lakh, 50 lakh rupees, and suddenly you see that 4 months time it comes down by 40%, and so that's inevitable. It will happen, but your ability to withstand through that period. So make sure that you're in the appropriate kind of fund. Also have an allocation plan. Make sure that you have 20% or 30% allocation to fixed income always. So you will be periodically rebalancing it. Be in small cap fund, but make sure that of your 100 rupees, 30 rupees in fixed income. So when investment value goes up sharply, you will be able to realize a part of it. That will become relatively stable. That will not go down in value. So you can create your own balanced fund with that allocation. Otherwise, my suggestion is that first time investor, if they are sitting on big gains, move to a balanced fund, because you have been an accidental beneficiary of this. It will translate into lower return, but that's fine. Important to develop a belief. If you are a relatively older investor, 2-3 years, and you have experienced it, you have understood how it works, maybe move to a multi-cap fund, diversify. So those same stuff, 3-4 things, 3-4 principles, never to forget that.
Okay.
Be with the appropriate kind of fund. Be diversified at all times. Be a regular investor. Make sure it's your long-term money. It's not the money which you need 6 months from now. No amount of me telling you that don't take your money out will help, because you need the money. So it should be aligned with your goals. And if those 2-3 variables are in place, I think you will be able to navigate through even any troubling time in the market.
Okay. 10 minutes back, you mentioned about no panic, nothing doing in a huff.
Yep.
And it has all to do with psychology and temperament.
Absolutely. That I think is going to be one of the crucial variables of successful investors and not so successful investors. And it's much easier said, because when you see real money going down in value, which could have been realized yesterday, then you have to really understand, because in the absence of a history, in the absence of experience, all those losses look permanent.
Okay. And are the funds equipped to handle a market fall? Most funds?
Many fund managers are able to withstand. A great fund is a fund which is able to ride the market well and is able to withstand a market fall better. If market goes down by 20% and if a fund falls only 15%, 12%, it has done its job. But that will be no consolation. Even a 12% decline in value will be a very severe decline. So investors, so funds do that. There are other funds which are able to do it much better. For example, the balanced fund. If the market goes up and down very severely and operates in a range, balanced funds will, because they will be rebalancing their portfolios on a daily basis. They'll be selling the market the day market goes up. They'll be buying the day market goes down, to ensure that they have a 65-35 allocation to equity debt, or 70-30 allocation to equity and debt. So those funds actually are able to withstand the decline much. They are able to benefit from it. Not only ensure that you get a more stable experience, they are less volatile, but they are also able to benefit from profit from those ups and downs of on a daily basis. And the diversification itself, because if you hold 5, 6, 7 securities, your financial success, or the financial worth will depend on those 7, those 8. Here you will have 40, you'll have 30. If you own 3 funds, you'll be more diversified. So the diversification is some insurance against a steep decline in some, but it's not a complete. It's not a absolute insurance. Markets will fall, and so will funds.
Okay.
Many funds will actually fall less. Many funds will fall just as much as the market, and some more. But that is how it is. And your plan, your approach to investing is actually key to success.
And very important that you remain invested. Don't panic, because a fund manager can do nothing. If you start panicking, he would have no choice but to...
if in fact that is one of the problems that we have seen in the past, and now we have to see how much it happens in the future.
Right.
Because a fund manager is not going to do magic. If you redeem your money, fund managers will sell. And that selling, right now we are actually in the reverse cycle. People are pouring money in mutual funds, so fund managers are buying, so the prices are going up. So to a reasonable extent, stock prices going up is contributed by investors' money pouring into mutual funds. If we see the reverse of it, the reverse will be as true. But you can all still benefit, and I'm confident that many investors will pull out. Many investors will trigger sale by a fund manager. But the investors who are able to stick through those periods, they will be able to buy cheap, make sure that they're able to ride the full cycle. But I fear that I think that This time it will not be as severe as we have seen in the past.
Okay. You mentioned 70-30 ratio, 30 being
For a balanced fund.
for
Yes.
being or fixed income. You mentioned.
Yeah, fixed income allocation of, it could be different for anybody if you are trying to work on your allocation yourself. It could well be 50% for a conservative person.
Okay.
So what will happen is that
But that is a must to have.
that is a fixed income allocation is important for any investor.
Any investor.
Otherwise, it will all be equity, and you will never get an opportunity. You will never get a trigger. You will never get a signal to rebalance.
Okay. You heard what Dhiren had to say, that when markets fall, remain invested, do not panic. Okay. So we move on to the Q&A session, and the first question is from Anil Modi. What could be a combination of leading indicators, if there is a fall in the market?
There could be many indicators. There are things which people talk about, that if the market cap or market capitalization of all the companies exceeds the GDP of the country, it could be one high PE ratio than the historical high, and if it exceeds a certain range, going above its own median of last 5 years, it's time to worry. That market is so expensive that it will correct.
Right.
If the companies, price earning, if the earnings yield of all the companies or the aggregate companies come to a point where it looks unjustifiable, it could be a reason to worry. There are some anecdotal things, that if you see the stock market hitting the headline in a mainstream newspaper, if it is the headline in a Hindustan Times or a Times of India, then it is time to worry, because or when your neighborhood guy, when your panwala actually starts talking about stock market, it's time to worry. But some of it could be true, but none of it can be conclusively said about that this is the signal when you should worry, because there are just too many moving parts. There are just too many moving things. Markets can remain expensive for a long period of time, and you might have many of these signals pointing to that, okay, market is overheated, it should correct, but it may not correct, and that is what investors have been doing for the last 1.5 years. Also, market is a very dynamic thing. Markets might look expensive, and companies do well, and they earn more money, and suddenly, on the same valuation, if you might look at 500 rupee, if a company is making 50 rupee, it might look expensive, that it is 10 times to its earnings. But suddenly the company starts making 200 rupees, and it starts looking cheap even at 500. So because everything is changing. Also, interest rates coming down can actually make stock market look, or the equities look expensive. If my risk-free return is 10% and it comes down to 6%, then at the same price, everything will look expensive, because the risk premium, what I was able to earn without taking any risk has come down. So there are many things. Nothing can be said conclusively.
What about the geopolitical scenario?
Geopolitical scenarios, I would say that most investors should look at these things as news. Should take note of it, but don't try to profit from it, because you should try and work on. I look at everything I divide every factor into two parts. Something in which you have a say. You don't have a say on the geopolitical scenario. You don't have a say in many of the things, the aggregate numbers. But you have a great say in terms of the kind of money that you are investing, your investment time frame, your discipline, your regularity. If you are going to invest your short-term money in the stock market, you are doomed. You could be in for nasty surprises. But if you are investing your long-term money, absolutely no problem. If you are regular about it, you eliminate the possibility of catching a market high. That's extremely important. Catching a market low. This geopolitical, domestic economy, domestic turbulence, the disruptions, the GST, this, that. I think, investors should, once you have your own variables in place, the controllables, on which you have greater control, then you have to work on one thing, that future will be brighter than now. That actually drives the stock market. If in 5 years' time, good companies will make more money, you will be well off. In the short run, there will be a lot of anxiety. There will be demonetization, people stop selling, there will be doomsday, prophecies. People will say that the stock market is going to will come to an end. There will be a downward circuit, market will go down by 12% in a certain day. there will be all kind of things. There could be political anxiety. Which government will there be continuity? Will there be turmoil? And but will we be better off 5 years from now, 10 years from now? I think so. We have seen the recent changes. If you look at the Reliance Jio and something changing, a lot of two big companies in trouble, and the third company, the challenger, incumbents in trouble, and the challenger thriving, and so and consumers benefiting. Likewise, we have seen the turmoil across industry. Many companies are still struggling. So, but is it going to be a better future? Will companies thrive and dominate some marketplaces, and will investors benefit from it? I think so.
Okay.
That should it's a general belief in our economy.
Okay. Sandeep Bhogra has written in and he wants your advice therein. Given the market levels, I decided to invest in debt funds and lump sum created STPs into balanced funds over the next 2 years. Is it a good move?
It is a great move, because one is that you develop any plan and stick to it, and you will have great belief in that. And this is your plan is a conservative plan. You are investing in a balanced fund, spreading your money over the next 2 years. I assume that it is a sizable money. This will also translate into some opportunity losses, because if you would have invested, look at last 2-3 months, if you would have invested all your money in your balanced fund at the outset, it would have gone up much more than what the money is earning in a substantial part of the money lying in the short-term debt fund. But sticking to a plan, making a plan, sticking to it, and generally benefiting, and the real judgment will be out only in 2-3 years time, when you would have seen ups and downs and you would have benefited from this. And even if it translates into an opportunity loss, this is a plan which has to work over a lifetime. 2-3 years or 1 year's opportunity loss is not something to be to get really worried about.
Okay. We've been talking about 2008, and this is a question by Firdaus. My portfolio lost 50% value in 2008. Now it has doubled. I'm 54 years old with 3, and my current portfolio value will cover for the educational expenses. With 3 means children. What should I do?
If any investment was done with a very specific purpose, that I will invest this much and it will turn into this much, and I will do this with this money. This is the goal. And if you have got that money, take that money out. Don't wait for the last moment, or take a reasonable part of that money out, maybe 2-3 years ahead of it. Because any great plan, achieving your goal, there can't be more satisfying thing than that. Don't get greedy about, and this is actually a non-negotiable and an important goal, ensuring child's education, for which you have been accumulating your savings. So take a good part of your money out, and you'll be assured that that is taken care of. Be little, leave a part of it which is not needed in a certain time frame, and congratulations, you have met your goal.
Yes. Gautam Dalmia has written in, I understand that now the equity funds will be benchmarked against total return indices. When do you think this will happen, and will the index funds also be compared against the total return indices?
Yeah, this was a recent change by SEBI, that every fund should be benchmarked against the total return, which and total return index means that the Sensex that you see on television or in the newspapers which is reported, it does not assume all the dividends that is being that will accrue to all the underlying companies. Sensex has 30 companies or Nifty has 50 companies. So there is a total return variant of that, which assumes reinvestment, because as an investor you have access not only to the change in the stock price, but also the dividend which is paid by those companies, which should accumulate in that. So that difference in the return of the total return and the raw index is about 2% per annum on an average. It can vary over time, but generally the total return index is 2% higher.
Okay.
This should happen shortly, in about 2 months' time, because every index provider is calculating their total return variant of its index. So in 2 months' time, it will be made public and will be available for public consumption and by the fund companies. And after that, even the index fund will be compared to that.
Okay. Let's take this last question, quite interesting, from Kushal. He says, what do you suggest to young investors entering the markets now when valuations are at all-time highs? Should we stay away till a correction or park money in debt funds and fixed deposits?
No, because one is that you're young, you have all the time on your side, and you should do, get into a conservative fund and be regular about it. Don't invest at one go. So that's the only way to go, because a lot of investors have done the waiting through 2017. A lot of investors did the waiting in 2016, waiting for that correction, which never happened. And there's a possibility that correction might happen, and it may not happen. Things are changing, and as we have been talking all through that, there are just
Weeks time. Till then, keep investing.